Mary now. The reason you're all here. Help me introduce Mary.
Well, good afternoon. Good afternoon. That was nice of Corey to make lunch. Yeah. I'm Mary Badowski. I'm Senior Banking Center Manager at Prosperity Bank in Richardson. I'm at Bowser and Arapahoe. How many of you bank with Prosperity Bank? Ooh, I love that. How many of you would like to bank with Prosperity Bank? That's why I'm here. Actually, what do I do? I'm called the Senior Banking Center Manager, and my role mainly is to develop business for my location, but my main role is lending. So I do consumer lending, so those of you that are looking for a new car for your real estate practice, I do those, but I also do commercial lending. So if you want your car to be in the business name, I can do that for you. So your CPA probably would love to talk with you about doing that. Our main purpose today is to teach you a little bit about 1031 exchanges. And I wanted you to know I'm a licensed realtor in Texas, and I've done this. And this will be a great review for me, but also it'll be great information for you guys. I think really take something great out of the class today. I wanted to introduce those that are here from Prosperity Bank so that you know who we are. And first of all, the most important person here, besides our speaker, is Angela Webb, my boss. She's our DFW area sales manager. With us also is Wendy Scribner from our trust department. Wendy is a trust officer here in DFW, and the 1031 exchanges that you want her to handle, she's the one. So just so you know, she's the one you'd be working with. Also with us today, Mark Lowe, who's a trust officer in our Midland area for Prosperity Bank. And Janet is really the most important person. Janet Lees is the trust administrator, and she works with Wendy. So she's another person that you would get to know through that process. Wanted to tell you a bit about our bank since not all of you bank with us yet. We are a community bank, and we make our decisions locally. We were founded in about 1983, and we grew by acquiring small community banks throughout Texas and Oklahoma. We're based in Houston. We have over 275 locations in Texas and Oklahoma, and our asset size, just so you know, is about 35 billion. That's pretty big. The seminar today, like I said, was sponsored by our trust department. They were very nice to do this for us and arrange for our speaker today. And I just wanted to let you know a little bit more about what they do. They administer trusts in the state. So if you have a client who is needing help with that, or you have a family member who's needing to establish a trust or an estate of some sort, that's what the trust department does. They also do guardianships, retirement planning. No one wants to retire in here, right? No, you're never going to retire. You're going to be selling, you're going to close a transaction at the title company and die right at the table. That's what my real estate partner says. She's going to die at a close. Asset management, they do that as well. They do escrows and 1031 exchanges, and they do custody accounts. So just so you know what we do. Now, to introduce our speaker today, I'd like you to meet Charles Pulman. He's senior counsel and partner with Meadows, Collier in Dallas. His practice concentrates on tax, real estate, corporate, and partnership. He's board certified in Texas law, and he's also a CPA. What a cool combination. What a smart combination. His real estate practice includes representing clients in disposition of improved and unimproved property, development of property, structuring ownership entities, tax-free and like-kind exchanges, and negotiations on all types of loans. His corporate practice involves representing clients in acquisition and disposition of businesses. So if you want to sell your practice, There he is, he's right there. Mergers, business entity plan. And then he also works with family lawyers having to do with divorce proceedings in tax matters and properly related matters. Mr. Pulman frequently speaks on a number of tax-related topics, and he's active in numerous charitable and civic organizations. He was admitted to practice in Texas in 1976, so he's been around and he's done some stuff. And he holds a BS in economics from UT Austin, a JD from University of Houston, and a Master of Laws in Taxation from New York University. Please help me welcome Mr. Pulman.
Thank you very much. That concludes my talk. Or I blew it. First, I'd like to thank Prosperity and Keller Williams for having this. I think the turnout, I mean, I'm impressed. Maybe y'all have the same turnout every time you have continuing education. And I also want to thank Becky for making sure that this thing on the screen works, because if it doesn't, I'm in trouble, which is happy to be sometimes. We're going to talk about one of the few remaining tax shelters that exist in tax law that's legal. There are some tax shelters that some people have, but some courts in the IRS frown upon. And this is like-kind exchanges. Like-kind exchanges have been around for a very long time. First one I did was noted in the late 70s, and we've come a long way since. What I want to accomplish in the time that we have this morning, or this afternoon, is to give you an overview of the like-kind exchange area. I'm going to pass through several topics to introduce you to them, not so that you can become an expert, not so that you can know how to structure the next transaction, but so that you can be aware of how something needs to be structured and when there could be an issue in terms of what a client wants to do, so that at least you can say, stop, we need to go talk to the tax professional to make sure that what you want to do will work. Because the interesting thing about like-kind exchange, as I'll talk about today, is that if you follow the rules, you win. It's tax-free. And the rules are pretty straightforward. But if you deviate from the rules, then your transaction won't be tax-free. So as I proceed, sort of debated whether we take questions while I talk or towards the end. So I'm going to give you the option of asking questions while I talk. But if I see that it's taking up too much time and I can't get through the material, then I will kindly ask that you write it down. And then at the end, towards the end, you ask the question or I can stick around. So, as a general overview, an exchange under current law, we'll talk about a little more, can only be done with real estate. And I'm going to go over with you what that means, the term real estate. Up until the 2017 Act, you could do an exchange with real estate and personal property, and it would be tangible and intangible. But the 2017 Act changed it. The other thing also, you need to stay to the very end, because Mr. Biden has proposed some changes to the like-kind exchange. And if you don't hear what I have to tell you at the end, then you're going to walk away with an incomplete understanding. The other thing is, to do an exchange, you have to have the same taxpayer who both sells the property and receives the new property. It has to be held for a qualifying purpose, meaning that the property you're selling has to be held for investment or for use in a trade or business, and the property that you're going to receive has to be received for the purpose of either investment or for use in a trade or business. You don't have to exchange one for the same, or you have to exchange an investment property for an investment property. It can be mixed, but this is the only thing that qualifies. So for example, if you're using a piece of real estate for personal purposes, it doesn't qualify. So there's another provision in the code under section 121 that makes shelter zone okay, but it will not qualify. If you receive non-qualifying property, it's called boot, such as cash, and the boot is taxable. Or if you sell property and it has debt on it, and you end up when the whole exchange is over with either a new piece of property with no debt, or a new piece of property with less debt than the debt that was on the property sold, the difference is boot and your tax law. You don't have to get cash in the tax law in order to be taxed. Normally, an exchange will be simultaneous, meaning the seller sells property and at the same closing table, the buyer transfers back lifetime property. Now that's in a perfect world, because usually that doesn't happen as much today. So there is something that we're going to talk about called a deferred exchange. A deferred exchange is one in which I sell the property, but I don't know what I want to buy. And there's a means by which you can structure that to still qualify if you meet what the rules are. There's also a situation where I have property that I want to sell. It's not ready to sell. I don't know when it will sell, but I've located property that I want to acquire, and I'd like to acquire it in exchange for the property I own. That's called a reverse exchange. We're going to talk about it. And basically, that's where you arrange to acquire the property you want before you sold the property you own. And again, it's structured properly. It will be lifetime. The rules for lifetime exchange under section 1031 are not reflected. If you qualify, you qualify. Now, what does that mean? Well, for example, it means, like number 11 on this slide, that if you have a loss in the property you're selling, but your transaction qualifies in exchange, then you can't recognize the loss currently and you'll follow the property that you acquired. There are two terms that are used and that I'll probably use today. The property that you own that you want to sell is referred to as the relinquished property. And the property that you want to acquire is called the replacement property. There's no magic to where those terms come from. They come from the regulations under section 1031. So this is basically the overview. You have to have the same taxpayer. You have to have a qualified purpose. You can't receive non-qualified property, and it has to be the same taxpayer. And if you follow the rules, you're tax-free. So whether you have 100,000 gain inside of the property you're selling at 10 million, the tax on that gain will be deferred until you finally dispose of the property in a taxable transaction. Or under current law, there's another way in which you can wipe out that gain and never pay tax on it. It's a little bit permanent solution, and that is you die with it. And if you die with it, then the gain is wiped out. I don't recommend that as a tax shelter. And under Mr. Biden's current proposal, he wants the taxes on the gain, on gain that is inherent in property that you own as your bill. I don't know whether dying qualifies as exchange. There have been two recent laws that were passed. One was in 2017, which was the Tax Act, that made substantial changes that we're going to talk about. One is an exchange can only involve lifetime property, which under the 27 Act is only real estate. You can't do personal property. So there was many exchanges prior to 17, but the business would do it with cars, they would do it with airplanes, they would do it with a variety of types of properties. And they would qualify as an exchange if you could make them like time. That has gone away, and we're going to talk about that more. Yes, sir? In the green?
Yeah. The question about, you are going to work at rental.
Well, the property you're talking about is real estate. Yeah, if you convert it into rental property and use it for a period of time, then you can qualify because it's real estate. But I take it that your question was you use it for personal purposes, you lived in it, or your family member lived in it, and didn't pay rent.
Yes.
And now you want to rent it to a third party. That will qualify, but you're going to have to hold it for a while.
How long?
How long? You know, that there is no magic number. Long enough that the revenue agent, when you're audited, doesn't question it. I'm not trying to be cute. There is no time period. So 6 months, 12 months, the longer you can do it, then the better you establish that I just didn't try and tweak the property, but I actually converted my purpose. That's the best. If I were to tell you a certain number of months, you're going to walk out of here and say, Mr. Pulman said, I only have to hold this for 6 months as rental. And the reason why I say that is because I had a client do that to me a long time ago in a casual conversation. He said, well, he told me I only have to hold it for 6 months. There was in the CARES Act, there was some special provisions that allow certain time periods of the lifetime exchange to be extended. It doesn't apply currently, but I just put it up here because you can see that Congress can periodically tweak what the rules are. So to go into a little bit more for the qualifying purpose, you have to hold it for productive use in a trade or business or for investment, and you're not holding it for sale. If you bought a piece of property and you within a relatively short period of time listed it for sale, then you're going to have a substantial question as to whether you held it for investment or you were holding it for sale. A lot of times that can come up if you have a real estate developer that buys a tract of land, they divide it up into, they subdivide it and sell lots. That doesn't qualify because you're not holding it for investment. There is a way to structure such a transaction where if you build a large tract for a while and you want to do an exchange, there's a way to develop it, but you got to dispose of the property and handle it in a different way. As I mentioned, the relinquished and the replacement property, they each has to be held for a qualifying purpose, but they don't have to be held for the same qualifying purpose. The holding test, which is to this lady in the blue.
I asked, yeah, that's good.
You asked. I thought you asked.
No, you said.
You must be a ventriloquist. No intent to liquidate or to use it for personal purpose, no matter what. You know, yes, I bought this home. I intended to rent it, but I couldn't find a tenant, so I had my son do it. 5 years later, I decided to do an exchange. Well, that's not that way, because it's family. It is not uncommon to acquire a replacement property and then want to transfer it into an entity, like an LLC. Under some circumstances, that could work, but you have to be careful how you do it. If you're trying to, if you bought a piece of property or you own a piece of property, or you did an exchange and you got the replacement property and now you want to contribute it into a partnership with some other people, you may blow your exchange if you do it within a short period of time, because you won't be able to establish that you are holding it for investment because you contributed it into an entity. If you contributed it into an LLC that is a disregarded entity, you all know what a disregarded entity is. A disregarded entity, for tax purposes, not for state law, for tax purposes, is an is an LLC, limited liability company, with one owner. And for tax purposes, unless you elect otherwise, that LLC will be treated as though it does not exist for tax purposes. And all of its business activity, income, expenses will be recorded on the tax return of the individual owner. That is referred to as a disregarded entity. That is in its most simple form. But the benefit is that if you have a disregarded entity, you can transfer the property into the entity, and because the entity is disregarded, you don't have to worry about triggering gain or losing your holding purpose, because it's treated as though it doesn't exist. But I have to say, only for tax purposes, not for state law purposes. So you have a LLC, you set it up, you file the articles of formation or certificate of formation. Then you have to treat that entity as though it's a real entity. Owned by somebody, you have to have a bank account that has employees, you pay them, you don't treat it as your alter ego. The exchange, the person doing who sold the property has to be the same person who gets the property. You can't sell the property and decide you want to buy another piece of property that has sort of an environmental problem on it that you think is a really good investment. Therefore, you're going to have a corporation that you only own buy the property. That doesn't work because the corporation didn't own the property it sold. So it has to be the same taxpayer. Certain types of reorganization, like mergers, consolidations, spin-offs, those can qualify to continue the holding purpose. If you liquidate a corporation into its parent corporation, that will qualify as the same exchangor. A testamentary trust, I'm just going to mention these, I'm not going to go through tax class. Grantor trust, they're disregarded. And then finally, number 6 is the disregarded entity that I mentioned. It's a real good vehicle, the disregarded entity, because it shields you from personal liability, but for tax purposes, it doesn't exist. So you have to follow. Yes, ma'am.
Disregarded entity, could it be a husband and wife, or does it have to be one? Is it one person?
It can be a husband and wife if it's community property. The interest is community property.
And so I understand.
Which is a very good question.
So it's very important who actually buys the first investment, like which entity buys it, because you then transfer while you own the property into an entity.
Yeah, you can do that and then hold it in the LLC.
And then because otherwise you buy it in your name and then you want to buy it in the company's name, you can't do that.
That's right. You have to do some planning. Although, as I'll mention in a moment, most of the time it works in the opposite, meaning that a partnership among several people want to own a piece of property and they want to sell it, and half of the partners want to do an exchange and half don't. And you can't do a partial exchange inside of a partnership. Sure.
So you know doesn't have a disregarded LLC. So we own the house that we've had recently for 20 years. So we could transfer it to the LLC to enter into a 1031.
But hold it inside the LLC.
And then hold it.
Is it rental?
Yeah, we've been there for 20 years.
Just my approach in a lot of the structure is not to get too aggressive, because if you're audited, which by the way, I've been doing this since '77, I can't even think of one. I have lots of experience with audit, but there's lots of cases that exchanges that exist, and I like to structure it so that from the point of view of we're going to get on and what questions would be answered. And my experience has been that I deal with a lot of revenue agents. No disrespect to anybody here who's married or affiliated with a revenue agent. Once a revenue agent starts asking questions about your transactions, it's your question. So So it's tax-free if the exchange is only a qualified property, which we're going to talk about. Receipt of cash or other property is taxable. And there's another slide that I want to point out. If you get, let's say you sell a piece of property for $500,000, and just to make it simple, you bought it for $400,000, and you decide you only want to do an exchange for $400,000, and you want cash of $100,000, and there's $100,000 of gain in the property, right? You can sell it for $500,000, you bought it for $400,000. The way the like-kind exchange rules work is if you get loot, which is called cash, or non-qualifying property, the loot carries out the gain that's inherent in the property that was sold dollar for dollar, not pro rata. So in my example of the 400 and the 500, even though you can say, well, I only used 80% of the money to do a lifetime exchange and I got 20% out as cash, therefore only 100 of my gain should be taxed. That's not the rule. So you have to be very careful about loot and how much there is, because you could do an exchange and it qualifies, but you have yourself within the game, you can get a tax shelter. You can do an exchange. This drop and swap is what I mentioned about the partnerships of property. They want to do an exchange. No, they want to sell it, and some partners want an exchange and others don't. There is a way to do it, but you need to plan for it, not do it after the contract is sold. You can do an exchange with new construction. There's a way to do it that we talk about where you can try and build the building during the permitted time periods. And interesting, if you own 100% of a piece of property that fee interest, you can exchange it for a leasehold interest in another property for more than 30 years. If the remaining life of the lease is 30 years. These are just some examples of what will qualify as real estate. So under the 2017 Act, real property only, no personal property, real property. Now these new regulations that came out that I'm going to try and go over here quickly, just to give you an overview. We look to state or local law to see what the state says is real estate. The regs have specifically listed types of property, and then there can be facts and circumstances. The way these regs are structured, you could have a piece of property that's personal property under a state law, but it'd be real property under the regulations. You know, they have to keep this a little bit complex, otherwise what would I do? So under the regs, it goes into great length of what is real property. So let's go over that for a moment. All right, it's land. It's improvements to land if they're inherently permanent structures or structural components. Inherently permanent, you know, like a building, something that is not movable, it's not intended to be moved, and if you moved it, it would cause damage or destruction of the property. It's fixed for an indefinite time, so like this comes out of the regs. In-ground swimming pool, roads, parking, fences, and then there's a long list of other items in the regs. I do not include the regs in your material. If you're so inclined to want to read the regs, send me an email. I'll send you a link. And then you'll have to tell me when you stop doing it. And then there's a list of factors to be considered. Structural components, meaning it's a constituent part of and integrated into the property. There's things set out. You know, like the HVAC and the plumbing, the wire, that's all part of the property. It's not intended to be removed. Unsevered natural products. All right, farming. You have products on the way. You have crops. The crops will qualify as real estate as long as they haven't been harvested. And then there's a category that the regs have called distinct assets, meaning you look at each piece of property in a building separately to determine whether by itself would it qualify as real estate, not necessarily because it's inside of the building. Intangible assets, there's, the regs have a list of what qualifies, doesn't qualify. Like, for example, partnership interests, stocks, securities in a corporation or part, they don't qualify as real property, even though the partnership in which you own a partnership interest owns real estate. You can't do an exchange on your interest in the partnership. Licenses and permits. If the license relates to the use of the property in your business, it will qualify as lifetime, which really presents some interesting possibilities. But if it's a business license, where you have to get a license, like a CO or something in order to move in, that will not qualify. If you look to state or local law, if it holds that the property is real property, then it will be real property, unless the regulations, of course, have a term that says it's not. And it applies to tangible and intangible property when looking at state or local law. So interestingly, the regs also say that what qualifies as real estate for 1031 purposes doesn't mean that it applies as real estate for any other provision of the tax law. So there are other provisions of the tax law that deal with owning real estate. You can't look to these regs in order to define what that means. And interestingly, property can be real property for exchange purposes, but be personal property for a different provision of the code. So I know this is technical, and I'm just trying to give you an overview of, many of the tax laws that have been passed over many decades usually start out with the word reform. Well, they're not reformed, they just make things more complicated. The regs are trying to simplify things, but in the meantime, they sort of complicated it because the prior regs had a very broad definition of real estate. Now, the issue of lifetime exchanges is going to become much more intensive. When you have something that's not just a piece of raw land or a building, but you have other components. And the reason why it's important is because if there are components that in the building that are being sold and they don't qualify as real estate, then as we're going to talk in a moment, you can blow your exchange.
Give me example, sorry, of the last one. It's just real property and not real property. Like, give an example.
Well, for example, these are, let me point out, these are examples in the regs of what they wanted to just give an example. So there's natural products, we talked about it, water space adjacent to land. That can qualify as real estate. Indoor sculptures, boats, shelters. The regs talk about an industrial 3D printer and a generator and being a piece of real estate if it's permanently affixed. I have a client that owns a medical office. They have a radiation unit that was in which the building was built around the radiation. In order to take it out, you have to destroy one whole wall. Partitions, steam turbines, pipelines, cell phone towers, land use permit, business operation license, they don't qualify. What that point that you asked on this other slide about property can be real property for exchange and not for something else. There's another provision of the code that deals with personal property. And if it's personal property, for that section, certain tax laws apply. What exactly, I can't give you an example, I'll talk about that, of what would qualify under 1031 real estate, but not under another one, but not under another section, but not under section 1245. When I come across it, bring me your email, I'll send it. It's also interesting that the regs say the property that didn't qualify as real estate prior to the 17 Act still doesn't qualify. Now, it didn't tell you what that is. So you have to spend time researching, did this qualify as real estate before the 17 Act. And because all the regs also say that the property that qualified as lifetime prior to the Act still continues with that. Now, if I haven't confused you yet, then you haven't been listening. All right, let me just mention quickly, there's another piece of the regs where I just mentioned that if you receive property as part of the exchange, like with the building, you see property that isn't qualifying property, then you could possibly close your exchange, because then you have proceeds from the exchange being used to acquire property that qualifies. Well, the regs say that if you have incidental property that is acquired as part of the exchange, that is like a guideline, a safe harbor, and that incidental property won't adversely affect your exchange. So, for example, if you have furniture and fixtures that are bought in connection with the building, the furniture and fixture, and you're using the exchange proceeds to acquire those furniture and fixtures, you won't blow your exchange as long as the furniture and fixtures don't exceed more than 15% of the fair market value of the real estate. If they do exceed it, then what I do is that I bifurcate the transaction between the seller and the buyer paying a portion for the incidental property and a separate portion for the real estate on 15% of the incidentals. So not to give them all that is what they're trying to do. And then one other thing, the effective date of these regs began for any exchange after December 2nd of last year. So they were in effect for all years. We've talked mineral interest, by the way, oil and gas interest will qualify for exchange. You have to be careful whether you're talking about overrides, royalties, and characteristics, working interest, leasehold interest to take involved. And you can't sell U.S. real estate and buy foreign real estate from exchange. Somehow Congress and the IRS thought that foreign real estate and sold it, you've never paid the U.S. tax on it. I don't understand. We're all patriotic, tax-loving Americans. So now I'm going to go into a little bit of some of the more intricate parts of the exchange area. There's a provision in 1031 that says if you do an exchange between related parties, like mother-son swap properties, and they're both real estate, that's fine. But if one of the parties to the exchange sells the property they got in the exchange within 2 years of the exchange, it triggers the gain for the other party to the exchange who still owns their property. So mother-son, there's actually a case. Mother-son did an exchange. Within 2 years, son sold the property he got from mom. Service said that's good. Son pays the gain, cash out. Then they went and get to mom and said, well, your gain is taxable. Now, she said, well, I still own my property. How am I supposed to pay the tax? Because she still owns the property. The IRS does not provide financing. Except when they've already seized the property and still owe more. So that's something to be careful of. I gave a simple example of mother and son family members, but it can go also extend between entities that have common ownership. It can extend between an owner of an entity and the entity itself. So it's just something to be aware of. Death is always an escape from the 2-year rule. So that's and then there's some other exceptions. It's like tax avoidance, That's really more of the food issue. Food. So the food is taxable, as I mentioned, and it carries out there. You know, I've had people call me to tell me they want to do an exchange. And the first thing I ask them is, what is the gain that's inherent in the property? And the reason is because I'm trying to determine, well, what is the amount of tax you're trying to incur? Because as I mentioned, unless you die, the gain isn't forever forgiven. The tax is not forgiven, it's just deferred until someday in the future when there's a recognition. So it's important to determine what amount of tax are you trying to shelter. Because setting up a exchange comes along with fees and costs. Because you can't do it yourself. You can't do, unless you do a simultaneous exchange, then there's this deferred exchange where you sell property first and then you buy. We'll come to this in a minute. That's fine, but you can't take the seat of the cash. You gotta get a third party to take the seat, but you take the seat of the cash yourself. So that's something that needs to be watched out for. We talked about foods, about cash or personal property, the liabilities in the property you sold reduced. If the property you got back, which is the net, the liabilities on the property you sold against the liabilities that you get back, so that the net, if you relieve the liabilities, the difference is tax being currently. There's a way to reduce that if the seller transfers cash to the buyer and try and make up for a difference in the net liabilities. Foreclosed property, sometimes you can try and structure it as an exchange if you get the bank to cooperate or the holder of the lien. And liabilities in excess of fair market value, like when you have no equity, raises the question of will that qualify for exchange? My view is with regard to exchanges under 1031, unless it's clearly not allowed, then the downside of doing an exchange if you're audited, and assuming that there's a reasonable position for the exchange, the downside is you overtax in some interest. Now, in some circumstances, you may have a penalty, you know, depends on the attitude of revenue, but it's something to evaluate. That just because it may not be clear, because as you may know, not everything in the law is clear, that in some cases it may be worth taking a position to do an exchange, and the downside is one that you can manage. Basis is important because if I bought this property in my example of 400 and I did an exchange and I did for 500, there's no death, then my basis of 400 carries over to the basis I got. So the gain is deferred. Because normally you determine gain as the difference between the selling price and your cost basis in the property. So if you ask your client how much is the gain, the client may say, I don't have gain, I bought it for 500, I'm selling it for 500. Well, then you have to ask the next question, did you acquire this property in an exchange? If the answer is yes, then you use the cost basis of the property for the sold to acquire the property that wanted he or she wanted to sell. So it's called a carryover basis. There is a way for the basis to be increased, and the holding period is also carried over. So if you held the property you sold for 8 months, and you bought replacement property, then that replacement property will tack on that 8 months. And then if you hold that property for 15 months, you'll get tacked on. Not 15 more months, but another 7 months. There are some gotchas in the exchange area where even though you had a good exchange, there's certain types of recaptures, like on personal property, you can end up being taxed on the recapture of the appreciation.
Can I?
Yep. Sure.
Can we go back? Maybe everyone understood. I didn't. Can you explain the
I'm
basics?
sure you're not the only one.
The basis on, so you said something about you bought it for 500 and you sold it for 500, saying that's okay. But you exchanged it for something that you mentioned before. Can you just go into
What I
that?
was saying was, I own a piece of property now that I bought last year for 500. I'm talking like a client. After doing this for over 40 years, I come to the conclusion, the first time I hear the story from the client is the best that ever gets. So the client says, I'm going to sell the property for 500. How much did you pay for it? 500. Okay, that's good, except you then ask the client, did you acquire this property from an exchange of a prior property? Right?
Yeah.
In other words, I'm selling property 2 that I acquired in the sale of property 1. And in that case, what I bought it for is not 500. I bought it for whatever I paid for property 1. In other words, if I bought property 1 for 300, sold it for 500, acquired property 2 for 500, now I'm going to sell property 2 for 500. Even though I, quote, paid 500, 200 of the 500 I wasn't taxed on. And there's a rule in the tax law that says you don't get an advantage on money that you weren't taxed on. So that's what I was trying to do. All right, let's talk for a moment about deferred exchanges. Many times, and when I'm starting to run out of time, if my friends in the back would let me know, that would be helpful. So, deferred exchange is one where I have property I'm going to sell. I have a buyer that wants to buy it, and the buyer said, "I'm not waiting for that. Either sell it to me now or I'm going to find something else." So, but I haven't located the property that I want to acquire. So it's called a forward deferred exchange, meaning I'm going to sell the property I own now, property 2, and I'm going to go out and find property 3 that I want to exchange back into that I haven't identified. It's called a deferred exchange, and there are rules. I'm just going to go over those rules because they're highly technical. If you follow them, you will. If you don't, you're out. All right? So, from the date you sell, I'm going to use property 2 in my example, which is the property I bought from the sale of property 1. All right, now I'm going to sell property 2. I go to the title company, I sign a closing statement, and I set up my transaction, and I sell property 1, and it closes. You have 45 days to identify the property you want to acquire, or would like to acquire, or may be acquired, with the proceeds from the sale of property. 45 days. If the last day ends on Christmas, it ends on Christmas. There's no extension to the next business day, unless Congress, like they did in the CARES Act, extends it. You have to identify the property by written notice. You give notice to the person who's holding sale proceeds, and you give it to the buyer of your property. And you have to describe the property you want with a certain amount of specificity, not just 1 to 5 acres located in the southeast corner of Custer and 190. So some people use property tax descriptions, some will use deed records and file deeds. You can use street address, but you have to have at least some specificity that identifies. So how many properties can you identify? All these rules are in the regs. There are limits to the number of properties you can identify. Because keep in mind, if you identify the property, you don't have to acquire all of properties. You can acquire one or more of those properties to finish your exchange. But if outside of that 45 days, you found another property you want to buy, you're out of luck. Because you have to identify it within 45 days, period. You can identify up to 3 properties, and there's no question about it. You can sell a property for 500 and identify 3 properties worth $2 million. They don't have to be an equal amount, but you can identify a property that's substantially more valuable than what you sold. You need to get some thought of how you're going to pay the difference. Then you give a note. You can identify more than 3 properties. And I start to say this, and I go, how to do this? But you can identify more than 3 properties. But the total value of the properties you identified can now exceed 200% of the value of the property you sold. I'm just telling you what they are. And any property you receive in 45 days, you get a 3 card. Anyway, and you can revoke any property within 45 days. The point of this is, you own a piece of property that you held for investment. You get a buyer at a great price, and you want to sell it, but you haven't identified. You haven't even started looking for the property you want to buy. Okay, so you try and put off your buyer as long as possible, and you start looking. And you hire a broker to help me go find some property to buy. The moment you close on the sale, the 45 days starts ticking, and you're limited in how many properties you can identify, but you can only acquire as replacement property the properties you've identified. So that's the takeaway, and there's no extension.
Do you have to close within 45 days or just identify?
Next slide. And you identify the property within 45 days. Now you have to close on the purchase within 180 days of the date you sold, in my example, property 2. Now, there's a little bit of a twist. You have to close. See what this says? The earlier of 180 days after the original transfer of the property you sold, or the due date with extensions of the tax return for the year of original transfer. Now, what does that mean? I sold property in December of 2020, and I set it up as a deferred exchange. Now, I just told you have 180 days, right? You close on December 31st. But it's the earlier of 180 days of the due date of the tax return for the year I sold property. So, if your client, maybe you represent people out there in the market. If the accountant didn't file an extension on my 2020 tax return, and assuming it was subject to the normal rules of April 15th, which this year there's been a lot of confusion with 2020 tax return, then you have to close by April 15th. But if my accountant filed my extension, then I have till October 15th at the latest, but I really didn't have 180 days after December 31, which would put it essentially at 2/3. Okay? I don't give out estimates. And as I said, but all this is in your paper. All I'm just trying to do is make you aware of this, right? So that you or your client, they want to do an exchange, they're asking you about it, they tell you something, you go, wait a minute. Somewhere I heard this guy talking about something. But you follow all these rules and you win. There's some rules that apply on what, essentially whatever you identify, you have to get back the same property. there's a 75% rule that says you get back 75% of what you identified. You have to get back what you identified. There's some, I told you that you can't receive the cash 10 minutes. So I'm just going to tell you, there's a way that is normally done. It's through a qualified intermediary. It's basically a third person, they're either the bank or the title company. They're set up to do the deferred exchanges. They hold the cash. They have the paperwork. And as long as they get the cash, you don't have the right to it, in accordance with the regs, then you're not taxed on it otherwise. I just want to mention you can do a direct deed to that's reverse exchange. I told you what that was. That's where I find the property I want to buy. The seller wants to sell it, but I haven't sold anything yet. There's a way to do this reverse exchange. I'm not going to go through all of it. Then there is also what's called, well, it's the reverse exchange. There's a revenue procedure the IRS issued many years ago that sets out the guidelines, safe harbors for how to do the reverse. You still use a qualified intermediary. And if you follow those rules, then you essentially buy the property first through the QI. And interestingly enough, the regs say the IRS revenue procedure that the taxpayer wanting to do the exchange can manage the property, construct the property, guarantee the debt. They can do everything except they just can't make money while it's being parked. Safe harbors, I'm going to skip. I'm just going to mention that if you own property in a partnership, I told you to mention to you that you can do an exchange in a partnership, and then it's going to apply to partnership law. So some people try and distribute the property out early on, and then the partners get undivided interest in the property that hold it as co-tenants. There's a revenue procedure that was issued in 2002 on guidelines for how to hold property as co-tenants and not be treated as a partnership, which is important because if you can be a partnership and not call yourself a partnership if you act like a partnership. There's something called the Delaware Statutory Trust, which is a means by which you can hold property with unrelated parties under a trust created under Delaware law that will qualify, again, if you meet the IRS rules. All right, that was the good news. Now, Mr. Biden, in his proposals, has a statement dealing with lifetime exchanges, and he wants to limit the amount of gain you can defer to $500,000 or $1 million if you can. You can sort of struck me when I read this. I work with a lot of family lawyers, mentioned divorce cases. So I guess this means that a couple did an exchange that hasn't been closed out. And they're in a divorce, they need to put off the divorce as long as possible. So they qualify for the million instead of $500,000. I will not be the one recommending that. So there's nothing more other than this begins with exchanges completed in 2022. So if you started it in October of 2021 and completed it in 2022, then this proposal will apply. All right, let me just mention, this is a proposal. I don't spend a lot of time thinking about proposals. I don't spend a lot of time reading proposals. I have a hard enough time reading all the updates of the past law as it is. We're trying to keep current with what the current law is. If this were to occur, it essentially wipes out the because if you're talking about the maximum gain is $1 million, well, I don't know, the tax rates essentially go to 40%. Well, then maybe it'd be worth it. You could shell for $400,000. What I don't, I mean, this is just a proposal. It's not legislation. It's not fleshed out. But So I sold a piece of property and had 5 million of gain. $1 million of the gain is taxed, is not taxed. I don't know how you put all that together, but the property required, make these allocations of basis and holding period. Maybe I'll be retired by then. I'll let some of the younger tax lawyers in my office figure it out. But that's on the table. But there's a lot of other provisions in Mr. Biden's proposal on taxes. But frankly, I just, some of them are legit, and some of them just really aren't very practical. Yeah. So that's my overview. I appreciate being able to be here and talk to you in person. I gave a talk a couple of Sundays ago at church, not about this subject. and we did it on Zoom. And then a friend of mine who wasn't on the Zoom, he said, "How did it go?" I said, it's really hard to judge how you talk to see when people are on Zoom. It's like, I don't know. Well, here, which was one of the first talks I've given, I can look at your face. I can look at your smile. I appreciate you don't have masks on, like so. And, it's much more intimate. So, I didn't see anybody false. I appreciate your attention. And look, it's an important area. And if rates go up and this proposal doesn't happen, people are going to be looking to do exchange. Years ago, at one point, capital gain rates went down to 15%. A client that I have that did a lot of exchanges, he said, "I don't want to exchange it anymore, I'll pay 15%. And there was a good reason. Then rates went back up and didn't. So things are in place. I don't know. I have everybody has a question on that. Yes, ma'am.
You may have addressed this and I just misunderstood it, like 80% of what you're talking about. So your example where you said they pay $400,000 and they sell it for $500,000. If they invested $50,000 worth of improvements to it, can they only deduct 15? Can they only take 15% of that cost or that expense away? Do you understand what I'm asking? So if it costs them $50,000 in improvements in order to sell it for $100,000 more,
then the 50 would be added in the base. Is
okay.
that what you're at? No,
Yeah.
I own a piece of property, I paid $400. But I had to put in 50 of improvements to sell it for $500.
Yes.
Right?
Right.
Okay, so my cost now is $450.
Okay. So they can take it off.
There's a formula you use to determine your adjusted basis. You start with cost, you divide the depreciation, you add in cost that you capitalize. Many people say, well, that's not a capital cost, and it's expensive. Anyway, maybe
You did. I just wasn't sure whenever you talked about the like the lighting and the furniture that you could only take 15% of that.
That's a different. That deals with not the lighting. It's really if you sell a piece of property and build it, and it has tables and furniture and fixtures. That's not real estate. So if the value of all that personal property you're selling is more than 15% of real estate, your exchange is okay, but you're going to get taxed on the money you got from that 15% of the ancillary property.
Okay, that makes sense.
I gave a talk, and I've learned this. When I talk to groups, it isn't so much how much you take away when you leave, because I realize it's how I make you feel. So I hope I make you feel.
An LLC, they invest in residential rental properties,
sell two on the same day, that I could on the same day? Can they go into one 1031 exchange, or do they have to do two separate 1031 exchanges?
Well, if you have two different buyers, I would do two exchanges. If you have one buyer, I think you can do one exchange. One exchange agreement. But you have to strategize, because if you put them together in one, you have less flexibility. Whereas separated, you may be able to close out one exchange but not the other. And you may end up in the same place as far as food, but you have to give consideration. If you were selling a group of properties to one buyer and you knew what you wanted to buy, and you're pretty certain to buy them all at one time, I would just do one exchange. I wouldn't do a separate exchange agreement. I just think you need to evaluate what your goal is and what you think is realistic.
Or just for fun?
Yeah.
You think someone's hard.
Yeah.
One thing we might want to talk about is at what point in the real estate transaction do they bring prosperity bank trust department forward?
Well,
How does that, at what point is that?
all right. When I have a client who's selling property, I ask them, do you think you might want to do an exchange? If they say yes, then I think it's helpful to include in the contract a provision that says the seller, or sometimes it's mutual, may want to do an exchange and the other party requires. So the broker would be asking that question, because the broker's on the front line. They're the one dealing with it. And at that point, then, well, I bring all the parties in right away. As soon as the contract is signed, I bring the QI in, I bring the broker, and then I bring the insurance agent, the accountant, to make sure that everybody understands where we're going, because you only have 45 days. You need to bring the QI in at the start. The QI being the qualified intermediary. It makes things much more difficult, which has happened to me, where I get a call that says, "Oh, we're closing next week and you want to do an exchange." Well, the problem is, I can get my part done, but the QI, whether it be a trust or I don't know, may not be able to get all their stuff together, and if you don't have all the proper paperwork in place before you close, then you don't have a good exchange. So there's really, if the client says, yes, I do want to, then get everybody together. If they say, I might, and then you go, well, how long is the closing? Is it 6 months, 9 months, or is it 60 days? And if it's 60 days, you have a short window to get everybody lined up. Because as I said, the like-kind exchange regulations are really form over substance. And as long as you follow the exact requirements of the regs, you'll qualify. Anyone else? Well, when the first of you publishes their paper on exchange.
Thank you. When you have anything to add as far as how they.
I want everybody to know that this is hard for in the area and marketing as well, but we're happy to talk to you. They have clients that come to different and that is also my card, so you can also have it. Either one.
do you mean?
You know, actually, I just want to add, it's really getting someone in to analyze the exchange because of these new rules. You don't know if you got real estate. You don't know if you're gonna have incidental property or not. So you need to someone needs to sit down with the client and say, well, what are you selling? And let's get the accountant. Look, I'm always there to sell, but I'm not cheap. So,